We have had a really exciting last couple days, really talking about all sorts of stuff around business. Yesterday, I had so much fun sharing my insights on blockchain, NFTs, really the future of digital fashion, and how we're going to be looking at incorporating these sorts of things into how we grow our businesses now and into the future. So if you guys missed that talk yesterday, make sure you head over to YouTube and sign up for alerts on scaling retail. We've got, over 400 videos. All of my talks have been recorded, lots of really great juicy information, and guess what? Education is a huge part of my personal platform because I've seen way too many entrepreneurs make really bad business decisions from having the wrong information. So my gift to this planet in terms of business strategy is this YouTube channel. So make sure you check it out. This NFT thing was super dope. At the end, we had people come up and they were like, oh my gosh, you changed my mind. You've opened up new worlds to me. And I honestly think blockchain and how we look at the future of fashion is significantly going to be impacted by how we look at things like blockchain, NFTs, crypto, etc. But that is not why you're here today. Today, we're talking about building an investor-worthy business. So everyone here wants money. Yes. Okay, we all want money from other people? Yeah, okay. Just wanted to make sure. Yeah, we all want money from other people because other people's money, we tend to think, can be really good, right? And in some cases it can be, and in some cases it cannot be. You have to be careful with who you take money from, right? Last year, Americans put $2 billion into their savings accounts. Holy bananas, that's a lot of money. We also have seen in the last few years a lot of deregulation of crowdfunding and equity crowdfunding and financing. What does that mean? You take $2 billion in a savings account, you take all of these new platforms where people are going to be giving you money in order to get equity in your business, and now you've got a tremendous market for all of us entrepreneurs out here who are wondering, wow, there's money out there, how do I get that money? I find that so much of conversation can be organically inspired by your questions, by your head yeses and nos, and so I hope today can be somewhat free-flowing in terms of what your questions are. I will caveat this whole thing and give you a little bit of background about who I am so you can kind of understand how to index my information. I am not an institutional investor, right? I don't have a family office. I do not work in private equity. My experience when it comes to fundraising is both on the side of brands, so helping my clients through fundraising activities, as well as angel investing and doing some equity crowdfunding investing. So when it comes to working with pre-revenue and early stage startups, that is where my wheelhouse is going to be. Very important to remember. If any of you guys are raising later rounds, do not ask me any questions. I will not have any answers. But when it comes to these very early stages of how you're looking at funding your business, friends and family, angels, even pitching to family offices, there are a lot of opportunities here for a lot of small fashion retail companies. So a little bit about myself. I'm the founder and CEO of Scaling Retail. We launch and scale fashion companies internationally. I've won a number of awards, including Women's Wear Daily, top 10 women, 20 women. Damn, I wish it was 10. Top 20 women in business. There are some other women who got in there. I've also won a Female Entrepreneur of the Year award. Last year, I launched a company called Rendell Co. We did $2 million gross in 6 months. Most wild ride I've ever had in terms of launching a startup. Luckily, I'm a co-founder of that company, so I got to reap some of the rewards. I'm not always that lucky when it comes to the brands that I launch. I'm starting to realize that. I should be more pushy about some of the equity that I'd like to take. And I also do quite a bit of speaking. So you guys are oftentimes seeing me here at Magic, but I get around in the pre-pandemic days. You could find me between, Paris, New York, San Francisco, LA, London, speaking at different retail conferences, as well as different institutions and schools, etc. I also have this super cool other side of my business where I get a chance to work with local governments. So the city of Coral Gables is a client of mine, and I get to do a lot of retail development workshops with all of their small retail stores. So I kind of do this really interesting 360 gamut when it comes to how I look at approaching the world of retail. As I was mentioning earlier, my brain kind of goes up and down the ladder, side to side, and with a goal in mind is really where I approach how I do everything. If there's no goal, there's no strategy. There are no operations. You can take all the digital marketing classes you want, but without knowing where you want to take your business, nothing you do today will actually be able to help you because you're not going to have context. You're not going to have the sequencing of it, right? So the very first thing is to get clarity on what you want, when you want it, and then we can figure out how on earth you're going to get there. So, our agenda. We're going to talk about understanding your goals as an entrepreneur. We're going to talk about raising capital and how much you actually need, which, gosh, let me tell you, it is so much more than you want to know. It is not yes. You're like, yes, it is. Yeah, it's expensive. Being an entrepreneur is expensive. Running a fashion company, very expensive. Also, not to get to the end of the story here, very risky, right? So we need to talk about how to de-risk what it is that you're doing. We're going to talk a little bit about how to raise capital, the fundraising process, what you actually need. Also really important to understand kind of different levels of fundraising, right? So these different levels of how often you would be fundraising, right? What is the whole point of that? Kind of what are you giving away? I know a lot of entrepreneurs get scared about giving away parts of their business, as you should be, especially if you have no idea what you have on your hands, right? But also very important to understand if you're the right person to be launching this company, if you have the right team that even makes you invest worthy, right? Investable. What the investors are looking for, and ultimately what makes a fashion brand stand out. So I'm going to start off by talking a little bit about this landscape of being a founder and being a CEO. First-time founders have a very hard time raising money from anybody. Your friends, your family, everybody. And the reason why is there's something called what's your experience? What have you done? What kind of time have you spent working in startups? How well do you actually understand the landscape of what you're doing? So having a core understanding of your background, right? Does my background lend itself to someone giving me money? Would I give money to someone? This is a great question. Would I give money to someone with that background? Right? Is their idea enough? That is very important. Sometimes all we say to ourselves is, if I only had a little bit of money for marketing, I would be fine, right? We all know that that is just not the case. Operationally, as a business that wants to get funding, right? We're not talking SBA loans, right? We're talking funding from these other kinds of institutions and people, right? We need to ask ourselves, what exactly are these people investing in? So let's talk about what they're investing in. You as a founder is really important. Ideally, you and your team is even more important. Your team may not be people who you currently pay, but your team has core competencies and round out what it is that you are offering into your business. As opposed to you being the be-all, end-all, you might have a co-founder. You might have a COO. You might have people who are currently advising you in these roles, or people who you've pegged that you would hire full-time that are currently lending their time to you to help you get things off the ground. But your team is very important. And the reason why your team is important is that it not only shows that you know the right people, but it shows that other people are willing to take a risk on you. That is important. Fashion companies have a high risk of failure. Why is that? Because they're very expensive. And when it comes to getting something off the ground, if you don't have the capital to get it off the ground, you are highly leveraging your friends, your family, to not only give you capital, but to help you actually with the manpower. It's not enough to have a couple $100,000 if you don't have the right people to help you execute and make it into something. So the first thing I would do is take a look at your team and take a look at yourself. What am I bringing to the table? What are my core experiences here? How can I round out those experiences? The next thing to really think about is, what is the category of business that I'm actually launching in? We've seen a lot of fundraising around direct-to-consumer brands. Why is that? It's easy to measure traction. It's easy to be able to hire an expert growth marketer, implement, make certain tweaks and changes, and actually be able to project how your business is going to be performing over time. In fact, I'm a huge fan of companies like Clearbank, who actually have software that plugs into your Shopify, that reads your data and basically tells you how much money they're willing to invest or give you short term. They now have an angel program based on the traction and based on the data that you currently are reading. So if your goal here, and everyone should have a direct-to-consumer strategy, but if your goal here is to really focus on direct-to-consumer, you have a bit of leverage here. The next thing to consider, right, is aside from it being a product-based company, right, is there anything else that's interesting about what it is that you're launching? Are you just another women's ready-to-wear brand? Right? Do you have goals and aspirations to take the data that you're actually receiving and turn it into, let's say, a tech product? What is it that you're doing with your data, and what are the bigger plans for your business? This is also very important, as your plans and your goals will actually determine what kinds of money you will be able to receive. If I'm a small company and my lifetime goal is to create a business that's going to revenue $25 million a year, in the audience, you might say it seems like a lot of money. In the world of investing, it's nothing. In order to raise capital for a business that's going to do $25 million a year, you'd be better off raising money from friends and family, starting to get traction, and grow slowly. One of my clients, when they first came to me, they were doing $250,000 in volume. In 5 years, we got them to $10 million. This was without taking any sort of outside investment. So if your aspirations are to hit, I would say, a small number, you may not need to go through the hoops of being able to pitch and raise money from people who want a percentage of your business, right? But your business is not going to yield enough to make it worth it to them. So let's talk about what makes it worth it, right? As an angel investor and someone who invests in companies that have a long timeline horizon and a high risk of not working out, in fact, it's Las Vegas's equivalent of being at the roulette table, we are looking at 3Xing our investment, right? We're like, okay, we're going to go in there and we're going to invest a little bit of money into a lot of different companies, and we're going to cross our fingers and say, you know what, we believe in the founder, we believe in what's happening here, and we're planning on 3Xing our investment. Anyone who's looking or has considered, and I'm telling you, venture capital has been one of the sexiest words out there, but if your business, right, is not planning on being $1 billion business, right, stop listening to those podcasts about pitching to VCs. It's not worth your time, right? In fact, what is worth it is spending the time to build traction, spending the time to get growth financing, right? It's time to shift our mindset from going through these big institutional companies, which sound sexy because we hear so many stories about IPOs and so many stories about what's happening in the startup world, but do not confuse the tech startup world with the fashion startup world. These are two very different markets. There's a little bit of crossover when you hear about companies like Rent the Runway, right, which have actually built out a tech product. Right? You think about companies like ThreadUp, or even companies that are leveraging and implementing blockchain. Right? These are tech products. Yeah, they're in the world of retail, they're in the world of fashion, but their core competencies have to do in the software and the systems that they've developed. It doesn't have to do in the product that they designed. So when you think about the things that you're hearing, right, in terms of venture cap and the startup tech world, do not confuse those fundraising processes with how we take a look at raising money for your fashion startup, which is going to be smaller increments, and really built on, again, traction. So, how many people here have an idea if they want to have an acquisition of their business? One. Okay, great. How many people here would like to run their business forever and have it just be a small family business? Amazing. And how many people here have no idea? Because it's like the rest of you, and and only a few people raise their hands there. So when it comes to having something like an acquisition, right, it's really important to understand, and I think it's great that there's some clarity here in the audience. When it comes to having an acquisition, it's really important to understand who the hell would acquire you and why? And do they have a track record of acquisitions of small businesses? And at what point do they acquire the business? Those are very important questions to ask yourself. And also, right, when it comes to who's acquiring the company, are you looking for a private equity firm to acquire your company? Right? No. Or are you looking for another institution, right, another retailer, another brand to acquire a company, and what for? So when it comes to understanding the end goals and end result here, getting a lot of clarity on where it is you want to end up is just as important, right? As who ends up being the people you end up pitching and the business model that you take to get there. Again, it is about reverse engineering from the goal. Oftentimes people ask me, well, what should I be doing? I'm trying to figure out, I have all these ideas, all these things I want to do. The first thing to do is to stop and get clarity, right? You have launched your business for a number of personal reasons. It is important to understand what those reasons are so you can actually get the right people to give you money, support, and strategic advice so you can achieve that. Right? So when I talk about an investor-worthy business, we're not just talking investment in terms of someone giving you a $100,000 check, right? We're also talking about the strategic advisors, the board that you're building, and anyone else who's going to be giving you help and support in getting your business off the ground. So understanding your goals, I think, is really kind of first and foremost. If your goals are to build a small business, let it grow slowly, have it be a lifestyle business. Understand the golden handcuffs that a lifestyle business has, right? You go in knowing, okay, there are going to be caps here in terms of certain goals, right? Because I'm not building this business to sell, because I want to have it have X, Y, and Z kinds of constraints. Constraints are very important. It's very important to understand how it is that you actually are going to be able to find that freedom, that satisfaction within those golden handcuffs, right? And that, I think, is also something we do not consider. As an entrepreneur, and I'm not a personal finance person, I'm just a co-CEO who works with a lot of founders, one of the things that we actually fail to recognize is as we're building up our own businesses, and I'm not going to go too tangential here, but how we're actually fueling our own personal financial goals over the long term. Right? And how you build up your business as an entrepreneur, the kinds of funding you take, your own business KPIs and metrics, which also equate to profitability, salary, and what it is you can actually be doing with your own money to kind of future-proof your life. These are all very, very important. And I hate to say this, but it's more often that women, rather than men, will bootstrap it, put so much hard work, time, and energy, not know when to quit, not know when to pivot, and end up having a business on their hands that does not satisfy their personal lifestyle goals, right? So that's also super important to consider as we're looking at building out your business. How much money do you want to make, right? These are really important things. At the beginning of launching a business, we often say, I'm going to throw everything I have into this. I'm going to rest everything I have into this idea. But if you don't know where the idea is going, if you don't know how big or small it will be, you might be investing your money into the wrong arenas. And that's very important to know sooner rather than later, because your life and your resources are an investment and you need to de-risk in all the right places, right? All of that to say, not everyone here should be an entrepreneur, right? And that's okay. Okay. So now that I've properly deflated everybody, let's move into the other components of how we go about raising money and what traction looks like and who all these different entities are. Now, what's really exciting is if any of you guys have put together a pitch deck, right, and you're looking to raise money, the first step in raising money is obviously you need to have something to raise money against. So if you are launching your fashion brand and you have an idea, but you have not invested your own resources into that idea, no one's going to give you any money, because at this point in time, you just got an idea, and unless you've had a couple exits or you're very seasoned, it's too much risk to give you money without any sort of proof. So the very first thing you need to do is take a look at your own personal resources. How much can I invest into this business in order to be able to gain some traction? Typically, you're looking at self-funding. This is before you would go to, and maybe you could ask some friends and family, but honestly, you're not going to get much money from friends and family unless you've pulled together a team and they feel more confident. You would also probably feel pretty shitty taking money from your friends and family, knowing that your idea was not more foolproof, because this is coming out of their savings, their retirement, and out of love for you. So you would want to de-risk their investment as well. Now, when it comes to how long you're looking at self-financing, I typically say 12 months leading up to launch, plus 18 to 24 months post-launch. Now, why do I think it should take so long? Well, the first 12 months, you got nothing. You're building. It's foundational. However much money you spend in branding, product development, website, etc., sunk costs. Even if that thing never turned live, you would still have to put in that money in order to just play, in order to get yourself ready. So 12 months leading up to it, really important to self-finance. Then you move into the phase of product market fit. You don't know if anyone wants your product. You don't know what you have. You have no idea how people are going to be experiencing your content, how often they're going to be coming back to your website. Things like lifetime value and customer acquisition cost, you've no idea what they are, right? You only have an idea of maybe what they should be or what you're goaling towards, but you don't actually have the mechanisms to be able to understand what they are going to be for your business. It is all smoke and mirrors at this point. In order to prevent yourself from giving away too much equity without knowing what you have, but also to not have other people be dictating your decisions, you're better off financing your business for 2 years, I'd say 18 to 24 months post-launch. This gives you the opportunity to invest resources in areas that you're going to be able to have the most control over. You're going to be able to hire and test a team and agencies. You're also going to be able to understand really specifically who that customer is. Now, it's not to say that I haven't seen people start raising capital after 6 months. In fact, I've also invested in businesses that have been, I would say, live for, I'd say 6 months, maybe not less than that, about 6 months. But they invested heavily in those first 6 months in order to understand their traction. So depending on what your income looks like, your revenue looks like from your business, if you do not have the resources to go big in the beginning and you're staging out your own personal investment over time, maybe because you're self-funding from your day job, or you want to be careful about what you're investing, that time frame, I would say, could be longer or shorter, right? That becomes a very personal choice. But the number one thing you're looking for here, guys, is traction, right? You want to see how many people are coming to your site. Are they coming back? You want to start to understand what the average order values are, right? How many units per transaction? You want to start to understand what kinds of social impressions you're having. Very early on, you're not going to have a net promoter score, but these are sorts of things that you're going to start to track and measure as you're building up your deck of what traction looks like for your business. Everyone's traction numbers are going to be different. It's going to measure based on not only your inventory strategy, but your brand awareness strategy, your marketing positioning, and ultimately, again, what those future goals are, how quickly you want to exit, right? How quickly you want to hit those financial milestones. It's not uncommon that we hear people say, well, if you want to make money, right, you have to put money in, right? You have to have money to make it. This is one of those cases within this realm of the early stages of having a fashion business that it bodes extremely well for. Right? Launching a fashion company is expensive. It is not uncommon between inventory management and looking at hiring the agencies and everyone that you need to pre-launch to spend about $250,000. It's not uncommon, right? Depending on how fast you want to grow and what those KPIs are, you're going to be investing more or less on a monthly basis, depending on that. But to know what that initial startup capital is, and again, it can vary. Not everyone wants to produce 4 collections a year. Some people want to produce 1 product a month. Maybe it's 5 products a quarter. All of those product costs will be variable, but your marketing and brand building costs will not be. And in fact, my suggestion for most people is to over-index on your marketing spend and your branding spend than it is to invest in product. You need to flip the script. Luckily for everyone here today, there are a ton of vendors here that are saying they'll do MOQs of 100 units. It's pretty amazing. All right. Let's move into, make sure I'm, okay, get them time. Okay, so let's move into different kinds of ways in order we can raise money. So we have this idea here of family offices. Now, what are family offices? Well, it's much like what the name says, right? It's a rich family, or offices, right, where you have a couple families that are coming together and they have someone who's managing their money. So when you think about raising money, what's nice about this family office approach is that they're actually going to be pretty open in terms of risk, right? They already have their resources that are invested in their revenue generating components that are more of a sure thing over time, right? When it comes to the allocation of spend that they're looking to put into these startups, they're going to be the ones that are going to be most interested in the values of who you are as a founder and the values of your idea, and they might actually be willing to take a risk on something that might not be so traditional. Now, as far as what the check size is that they're going to write to you, it'll vary between who you speak to. But in terms of finding the right fit, and this kind of goes in same alignment with an angel investor, it's going to be a very personal conversation, dialogue, and relationship. It's going to be someone saying, quite personally, let me open up my bank account, my checkbook, and write you a check because I believe in who you are and what your business idea is and the traction that you've had so far. So how do we start to find who they are? Well, places like Crunchbase or AngelList are pretty good in terms of starting to understand some of these places. I personally have found in the last 12 months a plethora of incredible investors on Clubhouse. And I don't know if you guys are on Clubhouse. Yes, really, yeah. Clubhouse is excellent. Now, what's great about Clubhouse, and now I think it's open to the public, but what's great about Clubhouse is actually you get these really niche investor rooms. You have rooms where David Rose, where the guys from Andreessen Horowitz, you basically have rooms where every major VC and small angel is getting into these rooms and talking about how to pitch, right? What their core values are, how they want to be pitched. And in some cases, you will get the opportunity to do pitch practice. Every Monday night for about 6 months, myself and another crew of like fashion executives would get together on Monday nights, and for 3 to 4 hours, we would workshop brands. We would have them pitch to us, right? We would help them refine what their pitches are, and we would bring investors on stage, right? Now, what's exciting about Clubhouse is it's an amazing opportunity. I should be a spokesperson. So what's amazing about Clubhouse is you have this opportunity to use your voice. You're not on camera. It's all audio, right? So there's a little bit of fear kind of taken out of that opportunity. But it democratizes access to these really incredible people that you may not otherwise have the opportunity to find, meet, or be in touch. And I will tell you that most of the people that I have met on that platform are genuine, authentic, and when they say they're willing to help, they really are. So my suggestion to those of you guys who want to start practicing your pitch or wondering how do I get in touch and find these people, right? That is going to be, I think, a great easy channel that's pretty much accessible to anybody. Now, the other thing I would start to look at is angel syndicates. All right, you can start to do some Googling and figure out kind of where all these different little groups. What's really exciting is that there are so many of them. Like I opened up this conversation, $2 billion, right, went into savings accounts, right? Angels, right, typically will write checks, I'd say at the minimum of like, well, you can get in at 10, but about $25,000. Right? An angel syndicate, a group of people coming together to invest, might be able to make an investment of $250,000 by just a few people. That's a lot easier than getting one person to write you a big check, especially if what you're doing is pretty early on. Maybe you have some traction, but not a whole lot, right? So start to do some Googling around these angel syndicates. There are a couple out there that I think are great. There's one that I'm a part of called the Hustle Fund. And what I love so much about the Hustle Fund is the way that they end up doing their levels of investment is they basically start off and they invest in what they call ridiculously early startups. They invest in people. So they'll go through and see hundreds of different businesses. They'll write a ton of really small checks and put them into their incubator program where they're basically doing their diligence, right? Which means that they're learning, they're researching with you, they're supporting you throughout a certain program. At the end of that program, the companies that end up doing well get another tranche of investment, right? And it moves up the ladder like that. That, I think, is ridiculously smart. We're only speaking to them a few times, right? There's not a lot of interaction usually. You usually want to have more questions answered. But in an environment like that, as an investor, you get a chance to really see your founder. As a founder, you get a chance to really impress these people who are going to be investing in your business. You're developing and creating great relationships. Now, there are also a number, which I'm super big fan of, a lot of women-led angel syndicates. Now, the reason that I love that this has become a big thing in the last few years is obviously there's been redistribution, thank God, of more money and power to women. And as a female founder, which I see quite a few of us in this room, it is also a really great idea to go to these angel syndicates because as we've seen through a lot of research papers and studies, when it comes to fundraising, unfortunately, there's a lot of implicit bias. And that implicit bias means I am more likely to give you money if you come from the same pedigree, you look like me, you talk like me, and we have the same reference points. So, as a female founder, right, you're more likely to be able to raise capital, I would say, from a female-led fund, because you're not going to have the same implicit bias going in, right? It's the same reason why people are like, oh yeah, I'm going to hire this person. They have a great background. They're from Harvard. I went to Harvard. You have no idea if that's a good person, right? We can't help implicit bias. We can do our best. We can work with it, but we're not always so conscientious of it over time. So I would say taking a look at female-led syndicates, one that I love is 37 Angels. But there are also, again, there are so many of them. And one of my favorite podcasts, which is so great, it's super short, it's called Female VC Lab. And what I love about that is it's quite literally 10 minutes each week. And this amazing host, her name's Barbara, she interviews a different female-led fund like every week. Now, why is that important? Well, it's important because it's going to give you a chance to understand how specific, right, these people are. Some people are specifically fundraising in like biotech, and you're like, but I'm creating a t-shirt company, right? So pitching becomes very personal, right? You want to make sure that who you're asking money from really aligns with what it is that you're doing, because who you choose to take money from, again, is really going to dictate not only them being a strategic partner, right? Would you rather take 10 million, not 10, well, yeah, 10 million sounds great, but would you rather take $10,000 from someone who is not going to be able to help you with opening up your supply chain, or $10,000 from someone who actually knows this and this factory, who's going to be able to broker you a better deal and actually help you leverage and make more money over time, right? It might seem like a small amount of capital, but who you take money from will actually very much support your long-term strategy and growth and be able to really help you when you're hiring and when you're able to hire more people, but also look for different partners and change up your supply chain. Now, the next thing that I think is important to think about here is crowdfunding. And I did kind of put together a short slide here on the different kinds of crowdfunding. There are a lot, all right? Maybe it was 10 years ago when we were all excited about like Kickstarter, right? And we were like, oh yeah, Kickstarter, I'm gonna like make a t-shirt and then I'm gonna raise some money. And most people did it wrong because they totally undercapitalized their projects and ended up raising enough money just to cover production for the free things. And then really Kickstarter, I think, was problematic for many, right? Really beneficial for a few, did incredible things for a very few. But for a lot of people who didn't come at this from a strong position or understand the use case of something like a Kickstarter, which is really a brand amplification platform more than anything else, right? I see Kickstarter as like a PR generator, right? Something to help you get the word out. A lot of people end up getting burned on that because they weren't able to really think about it more specifically. So I'm going to run through the list and I'll kind of go into a few that I think are most pertinent. But we have peer-to-peer lending, right? So that is, hey, I'm going to lend you money, right? And then I'm going to accrue some interest on that money and you're going to pay me back, right? There's a company like Nextseed that I recently invested, well, actually a few years ago. A friend of mine was opening up a restaurant. I was like, oh yeah, I want to help, I want to help you get started. And so I put some money in, and guess what? Every month I get a little bit of my money back plus some interest. I'm happy, she's happy. She was able to raise quite a bit of funding from her friends who all wanted to support, right? So peer-to-peer lending, I think, is a great platform. You have the equity crowdfunding, which is certainly, I'm going to give you money, right, in order to be able to have a small percentage, right, of what it is that you are building. Now, it sounds kind of glamorous because you get the opportunity to diversify as an investor into a lot of different companies. On the investor side, it's more challenging because it's like, am I really, like, what's my $250 really going to get me over time, right? So as the investor, it's kind of like, okay, for like a newbie who's just trying to like diversify, like that's really fun. As the brand though, it's a really cool opportunity for you. And the reason why is because as you look at your table, right? If you look at your kind of Excel spreadsheet over who owns what different parts of your company, so we call it like a cap table, right? Right now in the beginning, you may have 100% of your business, but if you actually raise some money from equity crowdfunding, let's say you get 5,000 people to give you money, well, those 5,000 people don't go onto your Excel spreadsheet, right? They're going to be considered one person. That's helpful for you in terms of, making decisions and kind of building out a healthy business in terms of who owns what and what kind of decisions can they make. So equity crowdfunding, I think, is really, really helpful. I would actually suggest for most of you guys who have some traction, right, who are interested in kind of leveraging the benefits of that PR play that, let's say, a Kickstarter has, but is actually looking to be able to raise capital and give away some equity. I would say equity crowdfunding is a great way to tap into your friends who maybe only have $250,000. Well, they have $250,000, a little bit different, but who only have $250 to be able to put towards your business or project, right? So that can be a great way to get some early investors and to be able to raise at scale. I would say in order to properly leverage something like that, you really want to be building up your social presence, because equity crowdfunding to an empty audience doesn't yield much. And you can only count on those platforms to promote your business to a certain degree. Right? So your traction numbers, in order to get you ready for that funding, should be along the lines of brand awareness. How do you build brand awareness, gain a following, get some traction, and then ask them to invest in your company? They're going to have to love your product. They're going to have to love who you are. But given that you're already going to nail those two things, that should be pretty easy and pretty fun. The next is the rewards-based crowdfunding, right? So that's obviously the Kickstarter components. Those are still good when it comes to, hey, I want to do a PR blitz. I want people to know what I'm doing. In fact, I want to give away free t-shirts with my logo on them, because guess what? Not only am I raising money for this, but now I'm going to be giving people products to help me brand and get the word out for my business. So that can be really interesting and fun depending on the two different ways in which you want to slice and work with it. What people don't really understand is the cost that's involved in this rewards-based funding. And the cost that's involved is not just in producing the item that you're giving out, but it's also in the PR that you're putting towards the campaign. It is also in that beautiful video where you're talking about your brand and the future of your business, putting together that beautiful slide deck over like how you're going to grow, the use of funds, and all of that to raise probably not so much money, right? I would say some of these other alternatives might be better. Now, you also have donation-based crowdfunding, right? GoFundMe. Right? I'm going to assume that none of us here are going to use a GoFundMe campaign in order to launch our fashion businesses, but there are certain cases where we have people who are saying, hey, I am extremely disadvantaged. This is my dream. This is what I want to do. This is my vision. And I am going to go out there and raise money and say, hey, who can I get to support me in making my dream come true? It's a very different product play. It's a very different market play. Again, not one that's going to help you reach scale, but another way of generating resources without having to give anything back. Then we go into profit sharing, debt securities, and a lot of these hybrid models. Right? So now when it comes to thinking about how we're raising money across other platforms, I would say the most important thing to consider in terms of these other different channels are going to be, am I willing to do that? How far along am I in my startup process that it would actually make sense for me to do any sort of profit sharing, for me to raise any money off of debt, and for me to look at combining any of these two models? The more mainstream approaches are going to be peer-to-peer lending, equity crowdfunding, and looking, I would say, at this rewards-based crowdfunding. Does that all make sense so far? Yeah, okay, let me go back. Go this way. Back. Oh, there we go. Oh, shit, sorry. Forward. Okay, great. So now let's talk a little bit about kind of what makes your brand stand out and how to be thinking about, and maybe I'll give you a high level of how people are traditionally thinking about raising capital. So when you guys hear in the news that people are raising money, and it seems like almost these days every tech founder is raising more money. Well, guess what? These CEOs are out there every 18 months raising another round of capital to give away another 20% of their business, right? It is very easy to see at a very high level how someone could raise so much money for their companies that they actually end up diluting themselves as a founder. And it's not uncommon to hear those stories. Again, mostly in the tech space, right? But I know everyone kind of hears all this news, and so it's important to kind of shed some light on it because it is true, right? You give away too much of your business, well, what's the incentive for you to run it, right? Is it worth it to make that salary when actually what you wanted to do was like build something big and own it? So when you come to think about things like, these different tranches of when you're receiving money, what it means to be fundraising, luckily in the fashion world, it's totally different. Right? The model that we should be looking at is the following. The very first thing you need to do is take a look at your own financial resources. right? How much money can I invest in this business? What are reasonable expectations, KPIs, and metrics that I can actually goal myself towards to know that I'm actually doing the right thing with my own personal resources? Once you have some traction, right? Business plan in addition, right? Not a full out business plan. I hate business plans. I'd say a strategic plan is more important. You need to know what you're doing with product. You need to know what you're doing with finance. You need to know what you're doing with operations. You need to know what you're doing with your supply chain, right? You need to know what you're doing in terms of hiring and capacity building. So when you think about building strategic plans, right, they're living and breathing and they're adopting and they're changing. Usually by the time you've written out an entire business plan, the market has shifted, especially in today's day and age, and you've wasted a lot of time when you could have been doing rather than just researching for yourself, right? Starting to pull together those addressable markets and things like that don't actually become really important for you unless you're following a different model or you're actually going after some later stage fundraising, right? Where you already have much more traction than you do in the very beginning. In the beginning stages, you're pulling together a hypothesis and a plan to help you reach KPIs and goals to then know if your business is even worth investing again for yourself, because you are the primary investor of your company. In fact, most other people will not invest into your business if you're not working on your company full time, right? I hear a lot of first-time founders say that they're kind of straddling the line between working on their business and working, at a full-time company. That's totally fine and great when it comes to building traction and looking to see what you have. But when it comes to actually getting, again, other people to give you money, you have to ask yourself, would I give my money to someone else who wasn't fully committed to this business? Likely not, right? So look at your own kind of personal levels of investment. What are the KPIs that you're tracking to? Are you hitting your own metrics? Are you reinvesting in your business? Then the next step I would look to is friends and family. What do I need to fuel the money for? Now that I have this thing, now that I have the traction, what do I need the money for? Maybe early on, if you have some friends and family that are generous, they might be participating and supporting you very early, right? It really depends on your network. It depends on who you know. These become very, very personal, not only decisions, but the access that we have is very unique to each and every one of us. We all have access to different people who are going to be able to support us or not support us in different ways. So friends and family can either come before you have your product, after you have your product and have some traction, depends on who you know. Then from there, as you're building up traction, right, then I would say now it's a great time to take a look at maybe some of these other angel resources. Perhaps you've already started to reach out and have those conversations and get to know them as you're doing product development and as you're launching your brand. Again, no one's going to open up a check unless they know you, right? Or there's some sort of emotional connection. And the bigger of the relationship, the better the relationship, the more money you're likely going to get, right? And more of the support and strategic help you're going to get. So I would say start to develop these relationships very early on with any of these angel syndicates. Start to get a feel for who they're investing in, what they're looking for, right? You may not end up raising money from them at the end of the day, right? But you're going to get a lot of support and guidance from people who are heavily invested in the entrepreneurial communities. That I think is important. Now, the one thing I did not mention on here in terms of raising capital, and I'm pretty sure someone's going to ask me this question, is what about accelerator programs for fashion, right? We hear a lot about accelerator programs in terms of the tech industry. You get put into a program, you get all these mentors, you get all these different people who come together who help incubate your business and help you launch. And, they take a small percentage of equity, but ultimately they're there to give you all the resources and you show up with maybe a product or an idea or some sort of MVP. Or maybe you have nothing and they're investing in you and their time because of some other components. In fashion, accelerator programs are really geared towards those who are in retail tech. It's not enough to incubate an idea and have a website and get through the first 12 months. But without runway to actually help you launch your business and see some sort of traction, you kind of just dead end there. So you want to be careful, right, as you're looking at these different ways of launching your business. It's very important to understand for yourself, what are my definitions of success? How much am I willing to invest in my company? How big do I want to go, right? How fast do I want to get there? Who do I have in my network that can support me either strategically in terms of, connections and leverage, right? And then also, who else do I know how many be able to ask for resources when I have something to ask for, right? You don't want to ask for something without knowing exactly what it is you're asking for. Now, when it comes to understanding, and I love this idea of traction, and it's something I've been talking about now for a long time, but one of my favorite podcasts is called All In. Now, what I love about this podcast is they kind of talk about all sorts of things, but the last podcast was really talking about traction. And what I think is really important and really special about the fashion industry, unlike the tech industry, right, where there's really just this tremendous like bloat in terms of like raising capital without profitability. It's like, you know, all these people are making all this money, but like, is the business model sound? Does it even matter if it's sound? Like, what's going to happen? You know, so there's all sorts of things with tech. When it comes to product and it comes to consumers and it comes to direct to consumer and it comes to actual P&L analysis, profit and loss analysis of a direct to consumer brand, the numbers don't lie. There's not that kind of wiggle room in order to have that sort of bloat. Either you have a great customer lifetime value, right? You have a great lifetime value to customer acquisition cost, right? Or, right, you're not making any money at all and you're still in that testing hypothesis phase. There's really, when it comes to selling product, there are really very little areas there for gray room, right? It's either working or it's in process. And if your company is profitable, right, or it's on its way to profitability, boy, do you have something on your hands, right? Your goal is to get your business to profitability, especially because you're in a product-based business, right? You can't survive without understanding those margins. It's not a SaaS product. It doesn't scale the same way. So today, and I want to open up for questions, but today, really the idea is, how do you frame your business financing, your growth financing, based on where you want to be? Who do you have in your corner, and who do you need to meet? It's better to know who you need to meet today, start to build those relationships, so that when you actually need something, right, you know who to talk to. And guess what? They know you, right? So what you do today to start to advocate for yourself and your business is also going to help you in terms of any sort of financing, whether you're going to, let's say, a factor like Hilden, because you want to factor wholesale POs, or now they're also getting into financing e-com businesses. You're going to know what they're looking for. You're going to be able to structure your business so you can hit the metrics that they need in order to help you grow, right? All right, questions? So either that was really good. Okay, no. I'm like, either that was really good and no one has any questions, or, okay. So I'm going to ask you to come up and take this mic, if you wouldn't mind. Thanks, Jonathan. Oof, good. And I'm going to sit down. Thanks.
Hi.
Hi.
Thanks for the talk. Back in Colombia, before the pandemic,
I cannot hear you very well,
okay.
darling. Thank you.
Here, before the pandemic, back in Colombia, I got 8 stores of fashion, and since then, things are going down. Now I'm starting the business back now in the US, but I don't know a lot of people here, and I'm trying to start my networking. What could it be the best platforms that could help me out before I get angel investors, starting to work for a PR person, marketing, and all this stuff that could help me out starting from the ground up?
Great. So the question here was on where can I start to network and meet people? Great. It's a great question. Meeting people is a pain in the butt, and it takes a lot of effort, which means you have to like people, which I do most of the time, but then it's oh God, meet more people. So first of all, you have to have an appetite for meeting people. And then the second thing I would say is I have never met more people in my life than I did during the pandemic. I was so overwhelmed with the number of people I met. Now, I didn't meet them face to face. I didn't meet them in person. I was so oversubscribed on groups. So oversubscribed. It was okay, and there's another group thing. So there are groups that are going to be out there. In terms of which groups you should be looking at, right? So I would say the very first thing I would do is I would get on Clubhouse. All right. In terms of being able to start to follow rooms, follow people, you start to get access to the most interesting people. I remember being in a room with MC Hammer. Exactly. Well, I'll tell you where he was, like 2 weeks ago at 6 p.m. In that room with me. No, but when it comes to finding places to network, I would say Clubhouse for me is kind of the most easiest place to network. The other thing I would start to take a look at, what are the different niches that you need to be researching. So for example, in public relations, there's a company called PRNet. They actually aggregate and have a lot of PR people who are a part of it. I would also start to take a look at podcasts and the corresponding Slack groups that come out of these podcasts. So for example, if you're getting really into a marketing podcast, take a look in the description of those podcasts. Generally speaking, almost everyone today either has a Substack, which was hard for me to keep up, but a Substack, and they also have a Slack group. Slack has become one of the most amazing ways to tap into and have access to these smaller forums of very influential people who can help you with specific things. To that degree, I'm a part of 25 Slack channels, right? That's a lot of Slack channels. Again, I already told you, I'm oversubscribed, right? But I would start by looking at who's producing the content you like, right? Like, what are the authorities in the area that you actually believe in their philosophy? And then start to co-create from there. Now, there is a plug I am going to make because a girlfriend of mine, Christy Hurt, launched this incredible Slack channel called the Collab. Now, the Collab is amazing because she's amazing, but also because it pulls together fashion professionals. Now everyone's gonna be like, holy shit, I gotta write this down. You should write this down. So they pull together fashion professionals all over the world, predominantly in the US. And there are channels and threads for basically everything. So she's a recruiter. So I first knew her from doing corporate recruiting for small companies. And basically you have channels in there that help you with sourcing. Everyone's like, oh my God, yeah. Sourcing, design, hiring, operations. Anytime I'm hiring for a client, I always post stuff on there. So I would say major plug for the Collab. I think it's a fantastic platform. But then otherwise I would say, instead of just looking at random groups, I would look at the people who run the groups, right? And then I would pull back from there because there are too many groups and too many places where I actually think the information is not current. Maybe it's too biased in one direction or another, and things that I wouldn't believe in, right? Which is why I launched my educational platform, because I was like, hey, people need to know the real stuff, right? So make sure that you're following people who you actually think are intelligent and that you agree with, and then look at their Substacks, look at their Slack channels, and then if you need someone, right, here's a great thing to do. Write that person and be like, hey, really loved your podcast on da-da-da-da. I'm looking to hire a blah, blah, blah. Would you happen to have any ideas? Right? Tap into people. People are so much more accessible. It's scary. Yeah. Other questions? Yes.
You talked about equity crowdfunding. I have a few questions about that. One, is there a platform kind of like Kickstarter where we can do equity crowdfunding? Mm-hmm. I would like to know that. I would also like to know, is equity crowdfunding individualized, or is it kind of like you invest this much and you're going to get this return on investment, like you guarantee it for everybody across the board, whether they invest $100 or $10,000?
Investment is risky for everybody who's investing, no matter how much money you put in. Your rate of return is going to be based on how much money you put in, right? So whatever that percentage is of what you think the return rate is going to be, but there's no guarantee. There's absolutely no guarantee on equity crowdfunding, right? It's a little bit different than that peer-to-peer platform where it's there are more assurances because there's kind of guarantors on it. So it's okay, I know I'm going to give you money and I have a much lower rate of return, but that return is going to be guaranteed, right? When it comes to the equity crowdfunding, it's risky, right? That person could be losing all of their money, right? And depending on what they invest in, whatever the return rate is going to be at that time. Again, these are so here's the other big thing, right? It's when you look at when someone's going to make money from something like that, I don't think there's enough education out there that tells people like, hey, this is not like you're going to make your money back in 6 months, right? You're basically hedging your investments over lots of different companies, hopefully, such that maybe one does okay, right? So like when it comes to, that's, as a brand that's raising money, that's not your job. But I would say for anyone out there who is investing in that sort of channel, it's really important to understand the time horizons by which you are investing on. If you shoot me an email, if anyone wants to send us an email, I'm going to give you my email in a second. Okay, here we go. Okay. These are some of the awards I've won. Okay, and if you want to send us an email, I will give you a list, right? And so that list will have on there places where you guys can look in terms of angels, equity, crowdfunding, et cetera. So instead of running off a list right now, where everyone's going to have to scribble, I will send out an email.
I just want to say one more thing. I've been following you since you did that Stanford Business School. It was called How to Start a Clothing Line on a Shoestring Budget. And it was really good. And you said, do you want to be rich or do you want to be famous? And I just loved it. I think I've watched it like 1,000,000 times because it's just, I think I memorized your the whole thing. I can quote it. So I just wanted to tell you I love your work and I think you were truly meant to do exactly what you're doing and I appreciate you.
Woo! Thank you. I gotta tell you, man, I wrote my first paper, very poorly written, when I was 9 years old on why things went on sale at Macy's. Okay? There is something wrong with a woman at 9 years old who goes, something's on sale today, but it was not on sale a week ago. It was such a bad paper, but it so much so got me the nickname of Macy's, which I soon was able to shake. But when I was in high school, I was scouring the job boards of LVMH. So I was telling you guys earlier, I've been blessed. I don't know where it came from, but I feel very, very fortunate and lucky. And thank you for your feedback. It means the world to me.
Thank you so much for a fantastic presentation. I have a question. You mentioned a business that you have supported and invested in, and within 6 months, they have grown into the millions. What is the unique factor for that business to achieve something so unique in a saturated market? Are they a niche? Are they specializing in anything? What is it? Outside of a great product that they've done to achieve such great success in a short space of time? Thank you.
Of course, fantastic question. Jonathan, can you grab that? Thanks. So you want to, and I want to caveat this, right? So when you think about like a brand, right? Think about utility products. So we're not talking about fashion, right? It's not a fashion brand that scaled, right? When you think about utility and what consumer market needs are, right? So this particular brand is a soft goods company, right, called Rendell Co. What did Rendell Co. launch in the middle of a pandemic? Can anyone guess? Face masks. Now, what made them able, or us able, since I own half the company, what made us able to do that? Very, very close ownership over our supply chain. Producing everything in the United States, everything in Los Angeles. My co-founder was living in LA. We were able to do back alley purchasing of fabric when everything was shut down. We were able to get our products made because this business was an essential business. And we launched it like a brand. So what was the first thing I did? I said, I am launching a commodity product in a world where everyone is launching this commodity product, but I want to launch it fashion. Because I'm a fashion person. Worked at Barney's, Gucci. I mean, I love it so much. How do I launch this thing fashion? What was the first thing I did? I hired an amazing photographer, right? We took great photos. We got an amazing, amazing copywriter. We actually also got a publicist. Our very first piece of press was in New York Magazine Strategist. We then moved on to Wirecutter in the New York Times, Martha Stewart, People Magazine, Oprah, you just about name it. In fact, guys, I don't know why I didn't mention this. All right, I'm so excited. This Sunday, my co-founder and I will be featured in Fortune Magazine in their Startup Year One series, which is super cool. So what we did is we basically launched it like a fashion brand. And what we took were kind of all the tricks of what people do in commodity businesses, which is like, really press on our margins, really make sure that we can do this at scale. And we implemented a lot of the marketing tactics that many of you guys are hopefully either implementing or planning to do in your own companies. What did we do? We had a single product. We then launched into a 4-pack, then an 8-pack and a 20-pack. Our advertising strategies that market to the 20-pack get the most 4-pack sell-throughs, which is actually our sweet spot. Right? So it's being smart about how we look at marketing. Now, I am in a Stanford Business School program, and it's a leadership development program. One of the most amazing classes I took was on the neuroscience of customer experience. Right? I took neuroscience, right, and how we look at customer psychology and applied it to a commodity product. Right? We too often do not cross-pollinate our brains. For a long time, I was subscribing to a chemistry set created for kids ages 12 and up. I happened to be over 12, and it was really fun because for those 30 minutes to an hour, I was able to basically create new neural pathways by learning and experimenting and making explosions, which is also really fun. So when I think about, and everyone should be thinking about this, which is like, how do I not just become a specialist in what I'm doing, but how do I actually borrow from other fields of study in order to be able to come up with the thesis and a strategy that I can play with, right? The other cool thing that we did is we did a direct marketing strategy, direct mail strategy, which is basically, we did, it was so cool. We basically did these flyers and pamphlets and put them in the mail, and that was a really fun and exciting process. Funny enough, it didn't have the same kind of ROI and yield on it as we would have liked, but when you look at our total blended customer acquisition cost, right? So the customer acquisition cost of that particular mailer, it was kind of like we broke even, which is like super not impressive. But when we took a look at our blended customer acquisition cost, right, looking at how every single touch point, right, direct mail in their inbox, right, also looking at things like their, retargeted ads, banner ads, PR placements, we layered up this cake like no one's business. Right? And that is what it takes to be successful. You do not over-index on one thing. You go after everything very cohesively. We launched that company with $5,000. And I hope all of you guys go out to raise very successful, profitable businesses. And remember, unlike a tech company, guys, like our models have to shift and change. So start to think about business differently because we are different. Thank you.